Okay, dear students, Assalamu alaikum and good afternoon to everyone. Maybe somewhere it will be good morning. I hope that each one of you have seen the first live revision class if in case you did not attend the class. So recording of each live revision class is available, but it is highly advisable to take the try to attend the each and every live revision class. And just the announcement which I did in the previous class also. Only the first two, not even the third one. Only the first two live revision classes, duration will be short. But from class number 3 onwards, duration will increase. We have started the topic cost of capital. And just after, I would say maximum 3 or 4 classes, just after, I would say from class number 4 onwards, we will start the discussion of recent past papers. Don't worry at all. But before obviously attempting any question from the recent attempt, that question will be shared first in your WhatsApp groups. And you will be having around 3 to 4 days to attend that question. And obviously, initially we'll be discussing topics from the past paper like cost of capital, and then we'll go towards investment appraisal like that. So in the previous class, we have started a cost of capital. Just let me write this. AFM June 2025 batch. Second live revision class. We have started the topic cost of capital. Okay, students, in cost of capital, we know that the objective of cost of capital is investment appraisal. And what cost of capital represents, the meaning of cost of capital is simply cost of capital represents the cost of financing. Now, there are different possible sources of finance from where we can raise the finance. If company raises the finance in the form of equity, the cost is cost of equity, which we have seen in the previous class. How to calculate KE? By using CAPM as well as DVM. Okay. Now let's start. If company raises the finance, and we have not discussed yet MM plus tax equation, which is the alternative of CAPM. And don't worry at all. We will discuss number one, number two. There's a change in MM plus tax equation also. So we'll be discussing that change as well. Okay. Cost of capital. If company raises the finance in the form of debt, now this is very important. If company raises the finance in the form of debt, simply company is taking loan to make investment. Then cost is KD1 minus T. Now, why KD1 minus T? There's only one reason. Can I say fixed payment of interest? Fixed payment of interest actually results in tax saving. That is why in case of debt, the cost is cost of debt after tax. Now, when company raises the finance in the form of debt, so there are different types of debts. And in each type of debt, there's a different way of calculating KD1 minus T. So for example, number one, let's talk about the bank loan. If your company takes bank loan, so number one, you need to know one thing, that bank loan does not have a market value. Why? There's a difference between bank loan and debentures. We know that debentures, they are being traded. They will be buying as well as selling of your debentures. But when it comes to bank loan, so bank loan is such an instrument which does not have a market value. So that is why we always assume, in case of bank loan, it is assumed that book value of the bank loan is equal to the market value. Now, How do we calculate KD1 minus T in case of bank loan? That's very simple. For example, if there is 10% bank loan, and let's say the tax rate is 20%, very easily we can calculate KD1 minus T. Simply take 10%, 1 minus tax rate. So in case of bank loan, the calculation of KD1 minus T is extremely easy, which is in front of you. Just take the interest rate 1 minus T, you will get KD1 minus T. Second, irredeemable bonds. Students, in case of irredeemable bonds, how do we calculate KD1 minus T? Simply, KD1 minus T is equal to I 1 minus tax rate P naught into 100. This I is the simply cash interest. Now, how do we calculate cash interest? Simply take the coupon rate. Coupon rate is the rate which is written with the bond, multiply by the par value. If par value is not given, then we always assume par value is 100. So simply coupon rate into par value will give you cash interest. The coupon rate into P is of course tax rate, P naught. Current bond price, X interest. X interest means excluding interest. So P naught is the current bond price, X interest. X interest means excluding interest. Whenever current bond price is given, nothing is mentioned. We always assume given price is the X interest price. In case of cum interest means including interest. If examiner wants to give you the cum interest current value of the bond, then it will be mentioned cum interest. Otherwise, nothing is mentioned. We assume it is X interest. Let's say we are having 10% redeemable bonds. Par value is 100. Tax rate 30%. Current bond price 118. Cum interest. Student, I want everyone to calculate KD1 minus C quickly. You have just 2 minutes to do it. KD1 minus C is equal to, of course, par value is 100. Coupon rate is 10. So cash interest is 10. 1 minus tax rate. This is cum interest. So you have to make it X by deducting the interest. So it will be 108. So KD1 minus T is 6.48%, or you can say 6.5%. Let's see the results. Yeah, 6.5 is correct. Good. Now, student, the more extremely important one is redeemable bonds. How do we calculate KD1 minus T in case of redeemable bond? That is very important. Now you need to listen carefully, okay? In case of redeemable bonds, the first priority of calculating KD1 minus T is YTM approach. Actually, when we are calculating KD1 minus T, we are saying it is cost of debt after tax. It is cost for the company, for the organization. Obviously, for the lenders, it is the return. So it means if KD is the cost for the organization, then same thing is return for the lenders. YTM is yield to maturity. In case of redeemable bonds, the first priority will always be YTM. How do we calculate YTM, yield to maturity? YTM is equal to number one, RF, risk-free rate, plus CRP, credit risk premium. Now listen carefully. Risk-free rate, we'll take this risk-free rate from the government bonds. For example, we are calculating a cost of capital for the organization which is having a redeemable bond which has maturity period of 4 years. Then in the question you have to see the government bond which has a maturity period of 4 years, what rate they are offering. So that will be RF. Here RF is simply the government bond. But my bond is having a maturity period of 4 years, then in the question you will find the government bond which has a maturity period of 4 years. So the rate on that government bond will be RF for you plus credit risk premium. Now, another name for the credit risk premium is default risk premium. Of course, your company will have a cost more than the RF. Why? Because your company is more riskier as compared to at least the government. So YTM, the first priority will always be the YTM approach. That is YTM is equal to RF plus CRP. CRP is credit risk premium. Another name for the CRP is default risk premium. And this CRP will always be given to you in basis points. And you need to know 100 basis points, they're equal to 1%. If examiner has given you 50 basis points for the CRP, so in terms of percentage, it is 0.5%. So simply 100 basis points, they are equal to 1%. Now, let's say you have calculated YTM. This YTM is actually the KD for you. So once you have calculated the KD or YTM, then obviously you just need to do 1 minus T. So let me repeat again. In case of redeemable bonds, the first priority always is the YTM approach. Now, it rarely happens that redeemable bond is given and let's assume YTM approach is not applicable. It's very difficult, but let's assume that. The examiner has given you the redeemable bond and let's say examiner has not given you any government bond rate, there's no CRP, nothing. Simply what I want to say, redeemable bonds are there, but YTM approach is not applicable. If YTM approach is not applicable, if YTM approach is not applicable, then we calculate KD1 minus T by using FM approach, which is IRR. But let me repeat again, FM approach of calculating KD1 minus T is not the first priority. First priority is always the YTM. But if YTM is not applicable, then we'll go for IRR. So KD1 minus T, by using IRR. Now, everyone knows that the shortcut of IRR is available, so we'll be using the shortcut of IRR to calculate KD1 minus C. But let me repeat again. Using IRR approach for calculating KD1 minus T for a redeemable bond is not the priority number one. Priority number one is YTM. If YTM is not applicable, then I'll go for IRR. Now, let's say if we are calculating KD1 minus T by using IRR, so obviously we need inputs of the cash flows. Let's say the maturity period of the bond is 4 years. Cash flows time 0, you have to have the market value of bond outflow. Then I will take interest 1 minus T. Interest 1 minus T. Interest 1 minus T. But in the last year, there will be interest 1 minus T plus redemption amount. Now, when we say plus redemption amount, for this redemption amount, students, I always say RTQ. Read the question carefully. Why? Because for the redemption amount, there are number of varieties which are possible. So when would the YTM approach not be applicable, or could you please provide situation? I think my first question is, have you seen the videos on cost of capital? Mohammed Saad, have you seen lectures on cost? So there's one question. The name of the question is your company. In that question, we calculated KD1 minus C by using IRR. Have you seen that? Yeah, I think you just forgot. Have you seen the question, name your company? So I think we have already done a question where YTM approach was not applicable. Simply the data was not given. So I'm just preparing you. If data of YTM is not given, then what are you going to do? And we have already done in our regular classes. Okay. Now for the redemption amount, read the question carefully, because there are number of possibilities. Number one, if nothing is mentioned, or it could be mentioned that redemption could be at par value. Nothing is mentioned, then we always assume par value. Second, there's a possibility examiner has mentioned that redemption is at par value. Second, redemption at premium. Obviously, if redemption is at premium, then examiner will have to mention that. Third, there's a possibility of conversion value also. Conversion value. Now listen to me carefully, students. Conversion value is only possible. Conversion value is only possible. Number one, the given bonds are convertible bonds. Given bonds are convertible bonds. Second, at maturity, conversion value is more than the redemption amount. Obviously, in that case, we'll go for a conversion value. Repeat. Conversion value can only arise. Number one, the given bonds are convertible. Number two, at maturity, conversion value is more than the redemption amount. Obviously, at maturity, when conversion value is more than redemption amount, then you will have conversion value. I'm just writing the fourth option, which I have not seen, but I'm just writing. At discount. Again, if redemption is at discount, it will be mentioned. Now, let us quickly use the Shortcut of IRR to calculate KD 1 minus T. And one more thing. All the shortcuts, students, all the shortcuts which are available in AFM, you are supposed to use them. And we will be using all the shortcuts while our live revision classes as well. Okay, now come here. Let's say 0, 1, 2, 3, 4. Well, let's say it could be 5 as well. Cash flows. I'm assuming the market value of the bond is 120. Outflow. Par value is 100. Multiply by, let's say the cash interest is 8% into, let's say tax rate is 30%. Can I say if the tax rate is 30%, then you need to multiply this with 0.7. I'm just assuming all the data just to show you the shortcut. In the last year, as I mentioned, you have to take the redemption amount as well. Now, redemption could be at par, it could be at premium, there could be a conversion value. Assuming the redemption is at par, we are calculating KD 1 minus T by using the shortcut of IRR. Just select IRR, select all the cash flows, close bracket, enter. We are getting 1%. So we are getting IRR 1%. So simply you just need to use the IRR shortcut. Now, let's say the redemption is, assuming the redemption is at premium and the premium is 15%. So it will be 115. So KD1 minus T is 4%. I hope the shortcut of IRR is clear to everyone. Yes or no, please reply. Students, can you comment on that? The shortcut. Okay, it is clear. Let's go back to the OneNote. Okay, now let us discuss an extremely important concept, and that is cost of capital. Actually, in case of diversification, the cost of capital which we calculate, that is, the name of that cost of capital is risk-adjusted cost of capital. Now, there are two possibilities. That is, we are having company's cost of capital. Another name for the company's cost of capital is current WACC. Another is risk-adjusted WACC. The question is, what are the conditions? Where do we use actually current WACC or company's WACC, and where do we use risk-adjusted WACC? Let's say number one, Of course, when I'm going to make investment in the project, my company is going to raise the finance. Number one, no change in the financial gearing. No change in financial gearing means there's no change in the debt to equity ratio. Now, please try to understand. When we are saying no change in financial gearing, it means that the way we are raising the finance, we are raising the finance in the proportion of our existing debt to equity market values. And in case of cost of capital, we always, whenever we are using the word financial gearing, it is always on the basis of market values, not on the basis of book values. For example, existing market value equity is, let's say, 60% and market value debt is 40. So new finance is also being raised in the same proportion. No change in financial gearing. Second, we are making investment in the core activity. Simply, you can say we are doing the expansion of existing business. Investment is in core activities. Means we are not doing anything different. We are making investment in the same business. We are just expanding it. Now you'll be using the current VAC. We are not doing anything different. We will be doing the same business. So simply expansion. Now, when we say risk adjusted VAC, now one possibility, no change in financial gearing, or post project financial gearing is given. There's a one possibility that is still there's no change in the financial gearing, or there's a possibility. What will be your financial gearing after you have accepted the project that gearing is given to you? If post-project financial gearing is given, so I'll be using that post-project financial gearing for calculating my cost of capital. But the second condition is extremely important, that is investment in a known core activity. It's a scenario of diversification. We are making investment in a different business. We are moving to a different industry. Investment in a known core activity. Basically, we're talking about diversification. We're talking about diversification. We are doing something different. We are moving to the new industry. For risk adjusted back, condition number 2 is extremely important. Because you can see that in the one condition number 1, it could be there's no change in the financial gearing. But condition number 2 for a risk adjusted back is extremely important. That is, we are making investment in a different business. We are making investment in a new industry. So investment in a known core activity. That is diversification. So in case of diversification, the WACC which we use, that is risk adjusted WACC. Now, very important point I want to highlight here, and listen to that carefully. In case of foreign investment appraisal, always we use risk adjusted WACC. In case of foreign investment appraisal, always risk adjusted WACC, always. Now there's a possibility that examiner is saying that your company is having a project in another country, but in the new country, you will be producing the same product which you are producing in America, let's say. Same product you are going to produce in the new country. Even though I'm going to produce the same product, I'll be doing the same business, but the country is not same, the country is different. I have to have the risk adjusted back. Why? Can I say the risk of running the project in both the countries is not same? Even though the product is same, everything is same, but environment is not same. Legal environment different. There are cultural differences. There are, of course, economically, both the countries will not be same. The government policies will not be same. So the risk of operating the same project in a different country rather than the home country, you will have a different risk. Your business risk will definitely change because of of course the country changes, the legal environment, economic environment, cultural differences, and so many other things. So you need to know one thing: in case of foreign investment appraisal, there you have to have always a risk adjusted back. Now listen, the way back there was a question on NPV, and it was a foreign investment appraisal question. An examiner deliberately gave a student company's WACC, current WACC. Examiner did not give any information of calculating the risk adjusted WACC at all. Okay. So in that question, students were required to highlight in their answer that instead of appraising this project on company's WACC or current WACC, XYZ company should have used risk adjusted WACC. Now, if the same question comes now, how will I get 1 professional marks for the professional skepticism? Simply, you are supposed to write that there should have been a risk adjusted WACC rather than the current cost of capital. For foreign investment appraisal, risk adjusted WACC is suitable rather than the current cost of capital. So it's up to you how you're putting that into the words. That you can simply write it is there's a surprisingly that there's no information of risk adjusted WACC, even though it's an overseas investment appraisal. So now if the same scenario comes, you have to highlight, you will be getting 1 mark for the professional escape. Obviously, you will be getting a professional marks for the professional escapism because the logical is risk adjusted WACC. Why they have given us a current cost of capital. Okay, now students, we need to learn how do we calculate a risk adjusted WACC, number 1. Number 2, first we will learn how to calculate risk adjusted WACC by using CAPM. Then we'll be discussing the preposition 2 with the change formula, which has come in AFM. And one more thing, have you people seen my videos on that plus tax equation with the change? Yes or no? Students, can you reply? Have you seen that videos with the change? One student has seen, others also. Okay, what is the agenda for the coming class? I'm just mentioning that. Number 1, we'll be discussing the approach of calculating risk adjusted WACC by using number 1 CAPM. Plus, we'll be discussing preposition 2 with the change. Don't worry, we'll be discussing in our live revision class. Plus, what is the approach of calculating a WACC of a company which is already diversified? And after discussing all these approaches, we will also discuss the past paper as well. And which question we'll be discussing, I will share that question at least 3 days before the class. But student, coming Sunday live revision class will be a little bit longer than first two classes. So first two classes, you can say that they are just warm-up classes. But from class number 3 onwards, the duration will increase. So students, is there anything you want to ask before I end today's class? That's just last minute of the class. Is there anything you want to ask? Yes or no? And students, we have to finalize the timings of the class as well because day will remain Sunday because I'll need more time because duration of the class will increase. And from class number 3 onwards, each class duration will keep increasing. So students, thank you very much that you have taken out time for today's class. See you all and others as well, inshallah, in the next class. So get ready for the classes now from class 3 onwards. Duration of the class will definitely increase.